and welcome to the Business Standard Morning Show. I'm Kanishka Gupta and let's have a look at the stories for the day.
This is GE Vernova, helping generate and move the energy that will change the world. Welcome to a new era of energy.
In a few days from now, India will take over the presidency of G20. The country, which is being seen as a bright spot in the dark horizon, will hold the chair for 1 year starting December 1st. In IMF MD Kristalina Georgieva's words, as G20 lead, India will leave a mark on the world for years to come. But for India, the presidency is coming at a turbulent time. The ongoing war in Europe is posing a threat to the global economy, which is already in dire straits. And visible signs of climate change are posing threat to humanity. But this may also be an opportunity for India. Let's find out how.
Come the 1st of December, India will assume the G20 presidency for a year and preside over 200 meetings that aim to secure global economic growth and prosperity during this time. Together, the G20 members represent more than 80% of world GDP, 75% of international trade, and 60% of the world's population. The G20 is a strategic multilateral platform connecting the world's major developed and emerging economies. Over the years, the G20 has evolved into a yearly summit involving the heads of state and government. Sherpa meetings are also carried out to negotiate and build consensus. Working groups and special events are also organized throughout the year. India's Sherpa is Amitabh Kant, the former Chief Executive Officer of the Niti Aayog. According to Kant, G20 meetings will be held in every Indian state. And the Leaders' Summit will be held in September next year in New Delhi. The meetings will cover the finance and Sherpa tracks, along with 10 engagement groups that will involve the private sector, civil society, and independent bodies. G20's finance track has 8 work streams, including global macroeconomic policies, infrastructure financing, and international taxation. The Sherpa track's 12 work streams include fighting corruption, digital economy, and environment and climate. The government recently released the logo for the G20 meetings and summit, along with a theme and a website. These were done through a speech by Prime Minister Narendra Modi, which also revealed India's 3 guiding principles going into the G20 presidency. First, serving as a bridge between the developed and developing world. Second, serving as the representative of the Eastern Bloc of nations. And third, insulating the G20 from some of the divisive pressures that have paralyzed multilateralism elsewhere. Other than an influence over the G20's agenda, the presidency does not come with any formal power. But the influence can allow India to turn the discussion in the directions it prefers. Put simply, this is an opportunity for the country to emerge as a leader to solve some of the most pressing issues facing humanity today. However, the details of how it will achieve that are complex. Under India's leadership, according to Amitabh Kant, G20 nations will look to find consensus on major challenges like a slowing global economy, a debt crisis that will impact almost 70 countries, millions around the world slipping back into poverty due to COVID-19, and the existential climate crisis.
Therefore, it's important to realize that if India has to work in its presidency, this is an opportunity for action. It's a moment of global crisis. As the Prime Minister rightly said, it's a moment of chaos and turmoil, but it's also a moment of opportunity. And therefore, we will work towards finding solutions to these challenges.
Among the 2 most important challenges, is India's climate action agenda at the G20, highlighting that the developed world has not lived up to its pledge of hitting $100 billion in climate finance a year to developing countries by 2020. Kant says the focus will be on ensuring that they provide adequate finance, keeping in line with climate justice. According to him, the other challenge will be getting the developed world to restructure multilateral financial institutions so that they are geared towards increased blended finance, first loss guarantee, and credit enhancement. The goal will be to make these institutions better vehicles for achieving sustainable development goals and climate action. The second key agenda item will be reforms in institutions like the World Bank, the International Monetary Fund, and the World Trade Organization. The aim is to make them more attuned to the needs and aspirations of developing economies.
Many multilateral financial institutions were structured in the post-Bretton Woods period. They are not geared for a post-COVID era. They are not geared for a post-climate change era. And therefore, our view is that there are two kinds of reforms required. One is the structural reforms relating to quota, etc. That is one part of the issue. The other is about ensuring that more resources flow for SDGs and for climate.
India's former ambassador to the EU and former deputy permanent representative to the UN, Manjeev Singh Puri, says with India in the G20 chair, which will be followed by Brazil's presidency, this is the time to push for reforms in multilateral institutions to reflect contemporary realities. He adds that the developed countries, which may have been opposed to such an agenda, can now see that India is chairing a group of the world's most important countries, including them. This will make them realize that having India inside the tent will be more advantageous to them.
In 2008-9, when the G20 at summit level convened, this was again a very important agenda item, reform at the Bretton Woods institution. And some elements of reforms, quota reforms, etc., did need. We were not great beneficiaries, neither were the Brazilians, but the Chinese were. Is it time that we are able to now do something else and push for things as far as we are concerned? I think it is certainly something that will have to be pushed. Most of the most important critical decisions get taken offline, and the G20, without any doubt, is perhaps the most important offline for the largest and most important global decision.
Puri also stresses that India is uniquely placed as it takes over the presidency of the G20.
India will chair the summit, the presidency next year, and also host the summit. Thereafter, it goes to Brazil and then South Africa. There is a constellation which is possible, but above all, I believe the fact that India would be there in the midst of it, a country which is going to be acknowledged as the largest country in the world within a year, a country whose economy is among the 4 largest economies in the world. And so people are not oblivious of this. They know this. They also therefore see that there is advantage to them in collaboration.
India's G20 presidency comes at a time when it aspires to become a $5 trillion economy and a truly digital democracy. Against this backdrop, the purpose of India's presidency must be to focus on those international issues that are not only relevant to the country's development trajectory, but also achievable through consensus.
Experts claim that India's informal economy has shrunk close to 20% from 50% a few years ago, thanks to digitization. It offers a host of lessons to the world, especially to the developing economies whose voice India wants to raise during the G20 presidency. Meanwhile, India is taking another big leap. It is rolling out 5G network after successful auctions, and the government recently claimed that this fifth generation technology is indigenous. Our next report offers an insight.
the 5G that we've launched in our country is completely indigenous, standalone. There could be some critical parts coming from, say, countries like Korea, but certainly not coming from somebody else. So completely indigenous technology that we can now provide 5G for countries which they want, which whoever wants it. So our 5G is not imported from somewhere else. It's our own, product.
Last month, while interacting with students at the Johns Hopkins School of Advanced International Studies in the United States, Union Finance Minister Nirmala Sitharaman said that India's 5G is not imported, it is a domestic product. Sitharaman also said that the Indian government can offer the indigenous 5G technology and infrastructure to other countries as well. Back home, a few days before the finance minister's US visit, the country's telecom minister, Ashwini Vaishnav, had announced that over 200 cities in India will get access to 5G within 6 months. And Vaishnav may be right. Telecom companies are working on a war footing to launch pan-India services. But is India's 5G fully indigenous? Maybe not. Both Jio and Airtel have already partnered with global gear makers for the smooth rollout. Reliance Jio has inked multi-year contracts with Ericsson and Nokia to get 5G network equipment. Under the contracts, Nokia will supply equipment from its AirScale radio portfolio, including base stations, high-capacity 5G radio antennae, and remote radio heads, while Ericsson's 5G radio access network products and solutions and E-band microwave mobile transport solutions will be deployed in the 5G network for Jio. Meanwhile, Airtel has signed 5G network agreements with Ericsson, Nokia, and Samsung. A telecom network has 4 parts: a radio access network, a core network, a transport network, and an interconnect network. While Jio said it will deploy a standalone 5G network which needs a new core, Airtel is putting in place a non-standalone 5G network leveraging the existing 4G infra. So at this point, India's 5G infra is a mixed bag. Unlike 3G or 4G rollouts, telcos this time are not entirely depending on global vendors for equipment and instead developing their own 5G tech. For example, Jio will be using its own indigenously built 5G core. Both Reliance and Airtel have also said that they are indigenously developing the next generation 5G stack. According to a Business Standard report, Reliance is building a 5G software stack with its own R&D team along with its US subsidiary Radisys. Emergence of platforms like ORAN or Open Radio Access Networks has helped Indian telcos to build their own 5G tech. For instance, Airtel has inked a partnership with TCS to build ORAN-based radio and an indigenous 5G stack. Tatas have acquired a stake in Tejas Networks, a developer and seller of networking products such as radio, which in turn has brought Sankhya Labs, which is developing 5G software. TCS will act as a system integrator, putting the hardware and software parts together on an ORAN platform. Airtel Tata will likely be a win-win for both, as Tatas will get to test proof of concept while Airtel will get indigenous tech. When it comes to other homegrown telecom gear companies developing 5G tech, it is a tall order. The government brought in a PLI scheme for telecom equipment making last year. While the 31 companies approved under the scheme promised an investment of over 3,000 crore rupees over 4 years, these companies do not have any orders from operators for 5G equipment, and the incentives under PLI are given only when the companies undertake production. According to R.K. Bhatnagar, Director General at Voice of Indian Communications Technology Enterprises, few companies that have made 5G radio design have no orders. Bhatnagar told Business Standard that domestic gear makers should concentrate on the private network market, and the growing number of government contracts where the requirement for 5G equipment like radios is not so rigid or so large. Let us hear from N.K. Goyal, who represents Telecom Equipment Manufacturers Association in India.
First of all, there is nothing as you can call 100% indigenous, because certain component parts are always imported. But when we make in India, we don't pay any royalty to anybody because we import the components. Some components and others are made locally. We have around 21 companies who have successfully demonstrated this, and they are putting up this now for trials in the real life situation. So they will come up, there is no problem, it will be there. As regards orders by private operators, because private operators has to start immediately and they cannot wait. So they have given orders to existing multinational companies, but even that case, we understand Nokia is making within India. Ericsson has plans to make in India. So if a company is making products in India, it is called domestic manufacturing, whether it is 100% foreign owned or 100% Indian owned.
Complete indigeneity in 5G infra and technology is still far-fetched for India. However, there is some progress on the tech front with 5G when compared with 3G and 4G.
Several tech companies across the globe have witnessed a steep sell-off as global recession fears looms large. In domestic markets, shares of new age tech companies like Nykaa, Paytm, and Zomato have fallen up to 68% from their listing prices. Since the companies continue to struggle with profitability, should investors keep these stocks on radar after the recent sell-off? Let's find out.
Consumer-focused tech stocks have witnessed a sharp sell-off since their stock market debut. Global tech sell-off amid withdrawal of liquidity and rising treasury yields coupled with high valuations butchered returns. These companies now face another blow. Lock-in period for pre-IPO investors will end this month for a number of companies, potentially supplying $14 billion worth of shares. This included companies like PB Fintech and FSN e-commerce owned Nykaa, whose lock-in period ended yesterday. Meanwhile, shares of Paytm and Delivery will brace for the impact on November 15 and 19 respectively. These stocks have slumped up to 30% over the past 1 month amid concerns that huge supplies from large investors may take the stock prices to new lows. Analysts too warn the expensive valuation and stiff competition in a weak macro environment offer limited upside in new age tech companies.
There have been a few brokerage reports having targets of 2,200 plus for Nykaa, but I would differ. Nykaa's earnings showed a good growth Y on Y since the base was low. But a 5 crore quarterly profit on a market cap of 52,000 crores, I still believe it is quite expensive. Even if one projects, say, 35% CAGR for top line and 85% CAGR for EBITDA till FY25, we end up at 100x plus of EV by EBITDA and 200 PE, unless we assume that it will grow at the same pace for the next 10 years. The other issue which bothers me regarding Nykaa is its treading into a new market of fashion, which could be quite risky. It could be one of those few which are venturing from beauty and personal care to fashion. I mean, we have seen a few luxury brands, global luxury brands, which have diversified from fashion to BPC, which is beauty and personal care, but in a limited manner. Now, I mean, can we extrapolate the success of BPC to fashion for Nykaa? I mean, I would doubt that. Also, a couple of senior level exits does make investors uncomfortable, though outwardly it may seem smooth in terms of the transition. Looking at Paytm, secondary markets realize early that finally valuations come from cash flows and not cash burn, unlike the PE investors. Also, Paytm was more of a hype on the brand, as its supposedly bread and butter business may not really throw up positive cash flows in the foreseeable future. It's got its fingers across financial services, hoping to monetize. But even here, there is formidable competition coming from the conglomerates who are now focusing on financial services. Since it has corrected sharply, the correction here on may not be steep unless the performance deteriorates. But upside too will be limited.
In the July-September quarter of FY23, Nykaa's net profit jumped 344% year-on-year to 5.2 crore rupees. Revenue from operations too climbed 39% year-on-year to 1,231 crore rupees. PB Fintech, the parent entity of insurer tech platform Policy Bazaar, on the other hand, narrowed its net loss to 187 crore rupees in Q2 FY23, as against a loss of 204 crore rupees last year. Paytm's net loss, however, widened to 571 crore rupees in Q2 over the previous year, while revenue jumped 76%. A steeper correction down the road could make these stocks a favorable bet.
Hardly they make profit, So it is, I will not agree that it is a great result. No, the valuation was very high. No, so I think, the stock needs to correct more to become attractive. So the P ratio, it is 1200 times. No, for which the company has to grow 50% CAGR every year, which I don't think will be very possible. If you take year-on-year basis, their growth was not that great. Year-on-year basis, they have grown 39%, if I'm right. So if that is the growth, I don't think this valuation, if it corrects another 50%, I would like it. Otherwise, no.
Since their debut at the bourses, shares of Nykaa, Paytm, Zomato, Car Trade Tech, PB Fintech and Delivery have crashed up to 68%. Analysts expect related stocks to see a turnaround performance once these loss-making companies start delivering growth and sustaining profitability. As regards today, macro reports, global cues, rupee movement, foreign flows and crude oil prices will dictate market trends. Besides, India Inc.'s quarterly earnings will continue to be tracked as companies like LIC, M&M, Adani Power, Hindalco Industries, HAL and Delivery will report the July-September quarter results on Friday.
Staying with the theme of financial markets, most of us know how to purchase shares. But what if you want to transfer their ownership? Our next report tells how to do it.
A share transfer is the process of transferring existing shares, its related rights and liabilities from one person to another. These include subscribers to the memorandum, legal representatives in case of a deceased, a transferor, a transferee, and a company, whether listed or unlisted. The documents include original share certificates of the transferor, self-attested copy of PAN cards for the transferor as well as the transferee, payment of appropriate stamp duty at 0.25% of the market value by way of franking or fixing the share transfer stamps, and the Form SH4 duly signed and filled. The process of share transfer includes a slew of steps. There are meetings between the transferor and the transferee for the share transfer, execution of share transfer deed, which is SH4, needs to be signed and stamped by both the parties. Then, in case of unlisted companies, the transferee or transferor will send the deed along with original certificates or a letter of allotment of securities to the company at its registered office. For listed companies, the documents will be sent to the registrar of companies. In both cases, this needs to be done within 60 days of the date of execution. The company, within a period of 1 month from the date of receipt, shall register the transfer and issue the new share certificate to the transferee. A company can refuse to transfer the shares in case all the documents are not furnished. Such intimation for refusal, along with the reason, has to be intimated to transferor and transferee within 30 days from the day of receipt of the share transfer deed. If a company fails to abide by these regulations, then the company and every officer of the company who is in default shall be liable to a penalty of 50,000 rupees. I will achieve.
the nation's trusted bank, SBI, the banker to every Indian.
Did you know that if you're gifting shares to a close relative enlisted under the Income Tax Act, it will not be taxed? But a gift of over 50,000 rupees to a non-relative is taxed in the hands of Donny. That is all for today. For more news, views and analysis, please log on to business-standard.com. If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.